Hi, everyone, and welcome. I'm Mohini Naidu, Senior Investment Analyst at Nedgroup Investments. 10 years ago today, Nedgroup Investments launched the Opportunity Fund, a medium equity balanced fund with the objective of delivering inflation-beating returns to investors looking to achieve meaningful growth of their capital over time while limiting their total exposure to equity markets. We partnered with ABAX to deliver on this mandate, who have the skills and expertise to invest beyond the traditional asset classes to add value through a broad range of asset classes and strategies. Today, we hear from Omri Thomas, lead portfolio manager of the Nedgroup Investments Opportunity Fund, as he reflects on the last 10 years. Omri, welcome. Omri, you and the team have been managing the fund since inception in July 2011. A lot has happened since we've launched the fund, with a rather ambitious objective of achieving inflation plus 5% over rolling 3-year periods, while limiting equity exposure to 60%. The fund has an additional risk objective of protecting capital over rolling 2-year periods. Now, looking back over the last decade, what are your thoughts on what the environment was like? Was it conducive to actually achieving these objectives?
Yeah, Mo, that's a great question, because if we just look back over the last 10 years and look what's happened globally, in South Africa, politically, economically, it's been quite a tumultuous period. I mean, if you go back 10 years ago, we just came out of the global financial crisis. And if you look at the South African environment, we've had the firing of Nene in 2015, we had Steinhoff locally, we've had the almost collapse of SOEs, corruption being rife and really impacting our economy. So in the past 10 years, returns from most asset classes compared to inflation have been actually quite subdued. So achieving the inflation plus 5 target was a very ambitious target. So I'm pleased to say that since inception, we're very, very close to having achieved that objective. But what we are pleased about, despite some hiccups along the way, and I can maybe refer back to some of those, we've managed to outperform the average low equity, medium equity, and high equity balanced fund. We haven't been able to match the market, but our volatility obviously has been much lower than the market. So we're quite happy with the performance to date. And I think you also referred to it. One of the second objectives was to not achieve a negative return over any rolling 2-year period. Now, if I'm not mistaken, there were sort of 8 2-year rolling periods in the 10 years, because obviously it only starts counting after 2 years. So let's call it 96. So only in 3 of those occasions, we haven't been able to achieve that no negative return over a rolling 2-year period. So call it about 3%. And all 3 of those periods coincided with the drawdown that happened when the COVID scare came in March 2020. So we've been pleased with the performance. We've been pleased with the mandate. It's a great mandate. I almost think of it like a bicycle race where you get your ups and downs, but hopefully you still achieve a good time at the end of the race.
Thanks, Omri. Now, given that the fund's mandate restricts it to a maximum equity exposure of 60%, I think it has done a remarkable job at achieving 9.8% per annum since inception over a period that equity markets delivered 10.9% per annum. So you successfully captured 90% of the equity market's upside, but at 2/3 of the volatility. So well done on that result. But as you mentioned, there have been some challenges along the way. So what for you were the biggest surprises or discoveries over this last decade? Do you have any learnings that you could share with us?
Sure. Yeah, well, it's a great question. And I think that's a nice thing about markets. It's dynamic. And the moment you think you know everything, that you are very close to that point of getting a nice whack. So I think if I reflect over the last 10 years, one of the biggest disappointments obviously was Steinhoff. That was a company we did a massive amount of work on. Initially, we were concerned about the cash flows. We did the work. we got comfortable, we had a sizable position, and only to be massively disappointed with fraud that was discovered at Steinhoff. So what that did is that did sharpen our risk management skills in terms of our single stock exposure. And I mean, we've used that successfully since then. We've had some of those protection on, as an example, Naspers, which is protected, despite it being such a big position in our fund, has protected a lot of the downside. So I think the Steinhoff learning really helped. And then the second one was when COVID happened. If you remember, we've always had these structured notes, which gives us a very attractive asymmetric risk profile. And during that period, there were a few of those notes that were handsomely in the money, with only short a while to go. And the internal rate of return was still looking very attractive. And we said, it's only 2 months to go, let's just ride it out. And then basically in March 2020, there was a massive hit to the European index, which impacted our fund. So that was another learning, is once you've made so much money on a stock or on a structured note, it is sometimes time to bag that profit and to bank it. So subsequently, we've used that very successfully still, and we have actually closed out 2 of our investment notes in the last year, where it's a very similar experience.
Thanks, Omri. Let's bring the conversation back to today, where we find that many things have changed compared to 10 years ago. So we're now in the second year of a global pandemic. Interest rates in South Africa and globally are at historic lows. We've seen massive monetary stimulus in an attempt to kickstart economies globally, and yet we find ourselves in a low inflation environment. So against this backdrop, what is the outlook for asset class returns going forward? And is the fund's objective of achieving inflation plus 5% still realistic or even relevant?
Sure, yeah, that is the great question, Mo. Now, I mean, if I start off with looking at global markets, I mean, the US market is at a new all-time high. Inflation risks are looming there, so I'm a bit worried about the global market. And obviously, if something happens to global markets, normally it eventually impacts us as well. But despite that, I think we're into an environment where global central banks cannot afford interest rates to go up too quickly. They'll try and do it in a very measured pace, which means that we're probably into this low interest rate environment for a long time still to come. Now, from a South African perspective, we haven't got those low rates. We've still got attractive real rates on the front end if you look at cash. But I mean, if you look at the long end, you can now buy a 10-year bond at inflation plus probably 6-7%. So on that 10-year bond, you're locking in a real return of 6-7% for 10 years. So against that mandate of inflation plus 5, that really helps. And then on the equity front, our local counters have not had the huge run than what we've seen in the international market. So a significant amount of our top 40 stocks are still trading at way below where they were 5 years ago. And if you look at the political environment, the economic environment, that is all improving. So if you think of the problems we had over the last decade, and if we look at the decade ahead and look back then, and you say, well, look at the political changes that's happened, look at how SOEs eventually got sorted out, I think we're into a much better political and economic growth environment. And we're starting off with relatively low valuations on our domestic equities. So I'm quite positive on the outlook for returns, and specifically for South African investors.
Thanks, Omri, for sharing those insights and very honest reflections with us. And thank you to you and the team for the work that you've done on this fund over the last 10 years. It hasn't always been a smooth ride, but then I think investing in equity markets in any measure never is. But I think that the fund's 10-year track record demonstrates its ability to achieve its objectives for longer-term investors with the patience and resilience to withstand periodic bouts of volatility. So we look forward to what the next decade brings us. Thanks a lot, Omri.
Have a good day.